Hello, this is Vincent Randazzo of Lowry Research, and I'm here to go through a very condensed version of our third quarter review and outlook. We'll examine some of the key market themes, the conditions of supply and demand, as well as what to watch for going forward. For those who are unfamiliar with us, Lowry Research was founded in 1938 to provide analysts and investment professionals with an unbiased, factual analysis of the stock market based solely on the law of supply and demand. The key themes of the quarter help provide us with a sense of the character of the market and the supply and demand environment, and in doing so, a perspective of what to watch for moving forward. Equities were basically mixed, showing a degree of selectivity largely dependent upon the market cap as well as the sector, where we saw small caps and technology specifically dramatically outperforming. Demand strength, therefore, was more broadly focused and a little bit more cyclical, as breadth actually matched price index highs with their own new highs. Buying power improved at the start of the quarter and also at the end of the quarter, but in general remains pretty tepid longer term. Selling pressure remained flat and range bound, and sellers have been basically uninspired to act. The last point is key. Lowry's history dictates that bull markets don't die of old age. Historically, sellers must overtake buyers and actively push prices lower in a sustainable way. When we look at the performance of Q3, we'd note that the first half's laggards were generally Q3 leaders. Here we see what amounted to a fairly selective performance despite the positive numbers. NASDAQ benefited disproportionately given its heavy weighting in technology stocks and small cap stocks, which outperformed. The NASDAQ, as a result, had its best quarter in almost 3 years. Now, the implication is that the market could be seen as broadening out this quarter compared to the first half, where the performance was driven primarily by large cap, defensive, dividend-paying stocks. But still, it remains more narrow than most typical healthy bull markets. Now, in addition to supply and demand, we also monitor breadth very closely and approach it from a few different angles. Now, one of those perspectives, as we see in this chart, is unique to Lowry. First, we take into account operating companies only in the NYSE. So we strip away those closed-end funds, the ADRs, the preferred stocks that trade on the NYSE, which we believe provide a more accurate view of breadth versus the traditional all issues advanced decline line, which is referenced in the media. Then we break out the respective market cap segments, where we see large, mid, and small cap operating company only advanced decline lines at the end of Q3 were all at or near all-time highs, and they're all holding this trend line, which dates back from the February lows. So we can see in general we're in good shape here, but what to watch for going forward will be if all these OCO advanced decline lines can stay divergence-free and also remain in solid uptrends as they have since early in the year. Now, what I mean by divergence is basically that we don't have a situation where we have a higher high in price and a situation where the AD lines do not also reach a higher high. So they have to confirm each other. Longer term, the overall supply and demand environment remains pretty challenged. Therefore, we're advising investors to manage risk accordingly and watch for the trend changes in each buying power and selling pressure, because it's those directional trend changes that's going to make the difference in terms of positioning for an advance or a decline. There's also little evidence to suggest that stocks have entered a new bull market. Rather, we believe that stocks remain in an old bull market, but a bull market nonetheless. Broad strength in more cyclical sectors are really the most likely and best demand leaders en route to further upside, in our opinion. Narrow or defensive leadership would be a harbinger of waning demand in our view. So without a weakening of Lowry's OCO measures of breadth and or a sustained uptrend in selling pressure on either rallies or sideways move in prices, the chances of an intense decline appear pretty limited. The reason why we say that about selling pressure is because if you have a situation where you have rising selling during a rally, then that's usually the sign that a bear market is starting and then you're in the very early stages of a bear market. Again, we don't see that, but that's something we really need to watch for. So as such, a major market top is not something that's foreseeable at this time, but monitoring Lowry's key indicators remains important given the pretty fragile prevailing supply and demand dynamic. Thank you for your time and attention. We hope that you enjoyed our presentation. Encourage you to contact us should you have any questions at info@lowryresearch.com. And also please continue to stay tuned to Lowry's Research by visiting Interactive Brokers Traders Insight as well as through lowryresearch.com. Thank you.